Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode is my regular guest, Lenore Hawkins, and we are going to talk macroeconomic trends.
Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
Lenore, you've been a regular guest on this show now for almost 3 years. I appreciate you coming on. Pre-pandemic, during the pandemic, now we are hopefully talking about the economy post-pandemic. You're always a wealth of information. You always bring lots of charts. Let's dive right in. What are your thoughts on the job situation today?
So we have a really, really interesting situation with jobs. It's one that we haven't really seen before. So just last Friday, we got the monthly employment report, and it was a disappointment, but all the headlines were kind of reading that it was a Goldilocks disappointment. You could see that we only got about 560,000 new jobs versus 671,000 that was expected, but it was a bit more than twice what we'd gotten the month before, so that was kind of good. Headline unemployment rate fell to 5.9% from 6.1%. Again, kind of sounds pretty good. The broader measure, which is what I like to look at, though, it's the U6 measure, and the U6 includes kind of everybody. The unemployment rate, and I'm not a big fan of just the headline unemployment rate, because it's just talking about people who are actively looking for a job, and it's not talking about people who are frustrated and kind of given up, or people who have perhaps some childcare issues, which is one of the things we're seeing right now, where businesses are starting to open up, but people don't have a place that they can have their kids go if they were to go to work. So somebody's got to stay home with the kids. So that's not somebody who's actually they're not going to be actively looking for a job in unemployment. The U6, the chart we have here, that shows kind of the broader picture, and that's at 10.2%. So you've still got the kind of larger labor pool. Over 1 in 10 people are still looking for a job. Now, that Lenore, doesn't sound so great. Yeah.
Hey, Lenore, can I ask a question right there? There are for hire signs all over Atlanta, Georgia, and I'm hearing about this all over the country. It's hard to connect those two. Help us with that.
Yep. Well, we will get to that when we look at the job openings. That is where things get really, really interesting.
Okay.
Because there's two parts to this, and you're completely right. So we've got that 1 in 10 people still looking for a job. What's also telling is if we look at the labor force participation rate, and this is what really concerns me. So when you think about the growth of an economy, what makes an economy grow? Just two things. It's the labor force, so people working, and it's productivity, how much they can get done. You put those two together, and that tells you how fast your economy can grow. One of the reasons China has grown so fast is it's been bringing all these people from agrarian rural economies, bringing them into the more modern era. That increases their productivity, right? When you have somebody working on a farm versus when you have somebody working in office, productivity goes up dramatically. That's why they've had such fast GDP growth. The US has been fairly stagnant. And here with this labor force participation chart, you can kind of see part of the reason that our economy has been growing so slowly since 2000. Part of it is the labor force participation rate. It's been going down. So the percent of people in the economy that are willing, interested, and able to go get a job continues to drop. And we saw during the pandemic crisis where that plummeted. That's over on the far right. It really plummeted. But still today, it is back where it was in the mid-1970s. And why the economy was so gangbusters and in the 1980s and the 1990s, later 1980s and 1990s, was because that labor force participation rate was just going up and up and up. And a lot of that was women coming into the workforce. So you had accelerating. It wasn't just that you had to increase the population of the country. You had a bigger percent of people that were going to work, and that's what made the economy boom. Since then, it's been ticking down, and it's very concerning right now to see that while it dropped massively, as you would expect during the pandemic, it hasn't really gone back up to even where it was, which was not so great pre-pandemic. So what we're looking at here, you were saying with the signs everywhere, like looking for trying to get people to come in and work. That came out in the JOLTS report that just came out this week. So the JOLTS report is the job openings and labor turnover. So what that showed is job openings hit a record high, 9.3 million job openings. So you've got almost a 1-for-1. There's about 0.94 job openings for every one person that's looking to get a job. And yet we have all of these looking for people to come work for us signs everywhere. And yet you've got all this high unemployment. So what's going on there? Well, there's a couple of things. The big favorite one is to complain about all the pandemic assistance funds that are going in, that's incentivizing people to stay home because particularly in the lower paying jobs, you're doing better if you stay home. Now, partially that's a bit true, but that's kind of an easy answer and it's not the whole story. There's also fear for people who have not yet been vaccinated, or depending on the job they may be going back to, there's still fears of this virus. So some people don't want to go back to work. Maybe they haven't been vaccinated. Maybe they're afraid to get vaccinated. Maybe they're afraid even if they get vaccinated, the people that they're interacting with. So that's kind of putting a damper on people going back to work. And like we said, there's also childcare, which is causing a big problem. Because remember, we had all these schools closed. Now we've hit summer. So people have been out of work. They've been staying home with the kids. They don't know where to put the kids. Maybe because of this pandemic, people are less likely to be willing to take care of someone else's kids. So you've got a big childcare headwind, which is also causing problems with finding jobs. And last, we have a really big problem in the country. And this is a kind of a double-edged sword with skills mismatch. The skills mismatch, I think, is going to be the biggest challenge. And so if go to the next slide, this is what is both concerning for the labor pool and fantastic longer term for what could be possible in the country. So this chart shows us the labor productivity. And you can see off on the far right, skyrocketed during the pandemic. Now, how does that happen? You had businesses shutting down, you had people having to work from home, and yet labor productivity just shot through the roof. It dropped again towards the end of 2020, but that was just because you had so many people coming back into the office, right? So there's going to be a little bit of a hit there. But what we saw during the pandemic, during all these lockdowns, as the economy got hit harder than it has been hit anytime since World War II, since the Great Depression, was companies, the one part of GDP that was expanding was companies investing in technology that induces productivity gains. And the pandemic forced us to use all this technology that we had, things like Zoom, with the internet, all these ways that we have to work kind of from anywhere, to be really productive without having to waste time commuting or traveling to a business meeting. It forced us to use these tools that we had, but we weren't before. Kind of keep doing things the way you're used to doing it, right? That's human nature. If it isn't broke, don't fix it. Well, the pandemic forced us to change our mindset, and it forced companies to invest in things like automation, both corporate automation in terms of having more and more of corporate functions automated, and also manufacturing automation. So you couldn't really have as many people squinched into a manufacturing plant as you could before with the pandemic, right? So that kind of automation, there's a big investment in that, and that skyrocketed productivity. So what we're seeing now is those jobs that have been replaced with automation, people who have those skills, they can't find a job. But that automation created demand for new jobs. And we have a mismatch between the jobs needed to support the automation and the jobs people had pre-automation. So that's what you're saying with these jobs, these signs. It's a combination of all of these things. Now, what's really, really exciting to me about what we're seeing with this productivity and what we're seeing with the kind of investments that people have been making is think about, we've all gone through this experience. A lot of people have gone through the experience of working from home, right, Jay? I mean, you've probably talked to a ton of people who've been forced to live with that. And they've realized that there isn't actually an awful lot that we can do that doesn't require the overhead of such a big office. So large corporations, small corporations can cut down on their overhead. That's really good because that was a wasted expense. And that means that they can invest in things that are more productive going forward. That's good for the economy. We've also realized that we can function with people working from lots of different places. So you have people all over this country who say they don't want to move to New York or Los Angeles. They don't want to move to a large city where they're going to have to deal with a hell of a commute. And for their personal preferences, for their family's preferences, reduce their quality of life. Those people now can be in a job that is a higher paying job, maybe a more productive job, because companies are going to say, you know what, we're willing to work with you now because we're figuring out how to do this. So where that person, as far as the economy is concerned, may not have been generating quite as much as they could, they had to, be okay with having a job that was maybe a little less challenging, a little less exciting, but they wanted to live outside of the kinds of cities that typically had those jobs. That person can now has the opportunity to have that job. That's good for the economy because increasing the use of labor, increasing what labor can generate is great for the economy. And then if you take a step back and you look at the whole world, we're now moving down a path where, you combine this with what's happening with the global digital infrastructure, where, we're shooting these low orbiting satellites that are going to increase access to the internet all over the world. And we're figuring out this whole remote working thing. Think of all the people all over the world who don't really have the access to education. They don't have the access to the more skilled jobs. They need to get the skills, then they need to be able to have access to the jobs. Technology is paving the way for that, where people who are just not highly productive members of the global economy are going to be able to get those skills. And they're going to be able to be part of the global economy in a way that's never before been possible. And all of this, so think about this, all of this, more people being able to be more productive, it's actually a deflationary. So despite all the headlines, we have some good cause to not be so concerned with inflation. And in fact,
Lenore, before we pivot to inflation, I want to unpack some of everything you just went through.
Wasn't dense at all.
First, you quoted a stat about the number of job openings versus the number of people looking for work. What were those numbers?
So there's about, for every unemployed, there's about 0.94 job openings. So there's 9.3 million job postings on the last JOLTS report, compared to about, was it like 10 million jobs are unemployed?
Now, I'm asking for a data point that you might not have in the back of your brain, but how does that compare to what we looked at over the last 5 years in terms of that ratio?
Really interesting. Okay, that's a great question. So what we had that became really, really interesting pre-pandemic was we got to the point where the ratio of job openings versus job hunters was over 1%, or sorry, over 1. So it was there was more job openings than we had people looking for jobs. That actually got to a little bit over 1.2. That's crazy. That had never before happened. And we had a really, really low unemployment rate, which what we talked about is that didn't really tell you the whole picture, right? Everybody talking about this low unemployment rate, that we were dropping down to record lows. And yet the labor force participation rate, one of those first slides that we looked at, was still quite low compared to where it had been in 2000. So people were not being prompted to come in off the sidelines, which is what you would have expected, right? There's so many job openings. Unemployment is so low, yet people aren't being pulled in off the sidelines. Some interesting things going on there. One of the things that we've seen that's changed in the economy is labor mobility that can kind of explain this. And what labor mobility refers to is people being able to fluidly move through the economy to where there are jobs available, move away from places where maybe there aren't so many and move to places where there are. And that mobility refers to not only geography, which is kind of obvious, but also to industries. And we've seen labor mobility over the past 40 years has really come down. A lot of that has been a geography. And what we've seen at the same time happening is a rapid increase in regulation, which is another thing that has me excited that this pandemic might be a silver lining. So we've seen this regulation go up, which has mobility go down, which kind of makes sense because if you think about how you get regulated on primarily on a state by state basis. So if you're in an area where those jobs are becoming less plentiful, but you're in some sort of an industry that's regulated, there's some licensing involved, the cost of moving from one state to another goes up. What we saw during the pandemic was an awful lot of those regulations just thrown out the door. It was necessary. It allowed things like teledoc, right? Where we could talk to a doctor like the way you and I are. You could do that, and that doctor didn't have to be in your state because before you couldn't really do that, which made it a lot less of an effective solution. But that's sort of been removed where doctors can practice now a bit more across state lines, which makes a lot more sense, a lot higher productivity that way. And we're even seeing a bit of that happening internationally where doctors outside of India have been helping patients in India. They still have to be careful because you're going across nations, but technology is really pushing. There's better ways that we can get this done, reducing those sorts of regulations that aren't really providing the protections that we need anymore, but are a headwind to growth and a headwind to labor mobility. Those need to go, and there's reason to be optimistic that those things are going to go.
Okay. But before we get to inflation and your thoughts around that, another thing to but it's really more of an anecdote from the financial services industry. Most of my viewers are financial advisors or people associated with the industry. And you're talking about the productivity that companies are going to see as a result of these technology enhancements and people being mobile. I actually think it's going to create a real problem in financial services, and I'm seeing it boots on the ground. So a large producing financial advisor now knows that they don't need Class A office space. They don't need an expensive branch manager. They don't need an expensive complex manager. They don't need that big brand name. Their clients don't care where they are. And I think those firms are in a lot of trouble. So there might be some industry specific issues as it relates to those productivity gains. But like you mentioned, everywhere else, net for the economy, it should be positive going forward, right?
Yeah, I mean, it's definitely commercial real estate's a little bit of a challenge right now because, like you said, a lot of companies, large and small, have realized, God, that money that we're paying for that office space, it's not really giving us the bang for the buck that we'd like. We don't need as much office space, and maybe we don't need it as fancy because, like you said, it turns out clients don't really care that much. People, and I think part of this is just, it's a really great thing. You think about the way the modern world has worked, where everybody gets up roughly the same time. Everybody gets in a transportation device, could be a bus, train, car, whatever, and at roughly the same time, all heads in towards the center, does their stuff, kind of eats around the same time. Everybody roughly the same, with a couple hour, all comes back out to their homes. That is such a bad use of resources, right? So that transportation from home area into work area gets massively used for very short time frames during the day. It's a big cost to society. And why are we doing that? Well, we're doing that because it's still kind of the model of the Industrial Revolution where manufacturing plants got set up on a schedule and everybody had to go into the manufacturing plants. This is an old tech mindset. And what the pandemic helped highlight was that old tech mindset. We don't really need that. We don't need to show up into the office with that mentality of like time on the shop floor is what mattered. And that was our inherited kind of corporate ideology, was that you had to have that face time. It's like, no, what mattered was just getting the job done. And wherever you can get the job done, great. And if you can get the job done with less overhead, even better. So that's, yes, while for for corporate real estate, this is going to be a little bit of a challenge, but real estate across the board is kind of having some problems. You've also got the issue with malls, right? Kind of getting killed. I think one of the greatest ironies of all ironies is Amazon now buying large malls to use them as large defunct malls to use them as distribution centers. Talk about like salt in the wound.
Right?
That's just mean.
I have a teenager and a preteen girl, and they could care less to go to the mall. Completely different, Lenore, than when you and I grew up. They're dead.
Oh my God. The mall was like, I remember Tiffany singing in the mall. I think that was like peak mall culture.
That's right.
Now anymore, you don't do that. Now, I mean, now kids will sit with their phones right next to each other and they'll talk to each other over the phones. Texting.
Yep.
It's a different world. And then, so when all that, like what you were saying with, they don't need the office space. They can do more with less. That's actually another deflationary when we're talking about real estate, right? Because there's a depression on prices there. So last week, Fed official Bill Dudley wrote in a Bloomberg column, and I totally agree with him, that while concerns over inflation are understandable, there's a couple of things that we need to see happen before we have actual real inflation. We need to have booming labor demand. And while we've got that demand, we're having a mismatch in there, and you still have a lot of slack in the labor pool that I think will get ironed out in the coming months between childcare, the stimulus checks, that the effect of that wearing off where people really need to go back to work, because we're still more than 10 million employed jobs shy of where we were had the pandemic never happened. Second, we also need to see wage growth. Now, we have been seeing wage growth pressures that have been a bit stronger than what we've seen in the past. And that's been one of the complaints, is that while corporate profits kept expanding, wage growth wasn't really keeping up with that, which meant that corporate profits were kind of getting outsized benefit versus wages. We're finally seeing some wage pressures, and that's great for wage earners. Kind of can be concerning on an inflationary front, but only if those wage pressures, the increase in the wages, is not counterbalanced by increases in productivity. And we're seeing really great productivity signs. So far, that's not really a big question or big concern. And third, we need to see those inflation expectations really become totally unhinged. Like, people just need to be panicking about inflation, because that can kind of become a self-fulfilling prophecy. And if you look at what's going on in the bond market, not really happening. I mean, the 10-year yield just fell to like a 2+ 3-month low. And we're not seeing we're not seeing the market pricing that. We're seeing headlines, but we're not really seeing the market price that. Reality is that we still have a material output gap. We've got about 75% industrial capacity utilization rate, which means we have an ability to make a lot more stuff. That's 10-ish plus % below where it could be. And with the U6 unemployment, that's that kind of broader definition of unemployment, those people who are kind of marginally attached or have part-time jobs, they want a full-time. That's still at 10.2%. So there's still a lot of slack in the system that indicates there's not really these inflationary pressure. So we need to keep an eye on this, but still no cause for alarm. What we are seeing that is giving the appearance of inflation. Yeah.
Lenore, before you move on to that, because we've had this inflation discussion for 3 years, and I tend to hedge to the other side. This past weekend, I took my family of 4 to the local Mexican restaurant down the street. That meal is usually $40. Ordering the exact same food this weekend, it was $75. Somebody on my team talked about a smoothie that she used to always get that cost her about $4.50. It now cost her $9. So it's really hard for people who have to spend money to not see that there's inflation out there. So what do you say to folks that maybe aren't taking quite the academic approach that you and Dudley are taking towards this, that are actually having to spend money on things that are going up pretty fast?
That's the tough thing, even using the word inflation, because it's used as if we're all meaning the same thing, when it can mean different things to different people. If orange juice suddenly is found to be the cure for cancer, the price of oranges is going to go skyrocketing, That doesn't mean that there's inflation. It means that the demand went up. Likewise, if Florida has a massive chill, and California too, and it destroys a ton of orange groves, the price of orange juice is going to go up, because in that case, you have a shock to the supply side. That also results in prices going up. That's not inflation. You've got either a demand shock or you've got a supply shock that throws everything off, and prices respond accordingly. What we're seeing right now is there's a couple of things. You've got a supply chain that is still a mess, global supply chains, because parts of the world were shutting down at different times than other parts of the world. You have container ships. You have record numbers of container ships full of things, like sitting off the ports in Los Angeles, Long Beach. Then you have other ports that are desperate to have empty container ships because they need to put stuff in them and they don't have them. Now, this used to all work kind of smoothly. We had because you think about that, those logistics, that's really complex. How to have full container ships show up, drop off, pick up stuff, go to the next place, drop off, pick up, right? That was a pretty well-oiled machine. You throw rolling lockdowns on a global basis all over, and those ships, which is really the heart and soul of global economy, they're all over the place. It's a big old mess. That's going to take quite a bit of time to work out. And that means that shipping costs are astronomical. And the challenges of getting raw materials, like a company that I do some work with in Italy, manufacturing furniture, the founders, been doing this business for like 50 years, said he's never seen anything like this, trying to get raw materials, the complexity, the costs, the shipping. And we're hearing that across the board. So yes, we're experiencing higher prices, but like the Fed's been saying, kind of transitory. There's one is the rise in transportation costs. And that's because all these things, the ships, the trucks that move things around, kind of all in the wrong places. They're full in the wrong places and empty in the wrong places. We've also seen oil prices rise pretty quickly. I mean, you remember there was a time last fall where a barrel of oil, you actually got paid to take it. It went below zero. And we just hit over $70 a barrel for the first time since like October of 2018. So that's actually increasing, but that increase is not going to continue. We're seeing China, there's a bit of a demand shock, rising demand for grains and soybeans. So that's kind of pushing prices up. Then to make this all even more fun, a really bad drought in Brazil. And they're a big exporter of corn and soybeans. And also we're seeing a growing demand for vegetable oil for biodiesel. So that's another kind of shock on the demand side. Putting this all together, yes, prices has gone up. I mean, to your point, global food prices rose by the biggest margin in a decade, according to the United Nations Food and Agricultural Organization's monthly index. It jumped 40% in May. But human beings, we tend to think of these things as kind of linear, like it's just going to keep happening. These are one-off shocks. They should be. I mean, that's what we're expecting. If in the fall, we're still seeing these price increases, then we need to rethink this. But for now, have every reason in the world to believe that this is still much more just transitory.
So before we move on from inflation, do you think, due to governments benefiting from not being completely truthful about the inflation measure because of liabilities that they have to pay, and I am not just talking about the U.S. government, all governments, there have to be some other resources to measure inflation, not just for financial advisors and portfolio managers, but for people. What do you look at?
I like the billion. It's MIT has this like billion price metric that goes on the internet and it scans like the prices of billion things. It's much more diverse because, like, for example, the government's, the CPI, the one that they use, the core CPI, it takes out the cost of energy and housing because, those are things we don't care about.
Yeah, don't go up a lot.
Right. Those don't really matter. They're not a material portion. Yeah, I agree with you. These measures the government's official measures are highly inaccurate, which is actually one of the problems too we're facing with measuring productivity. because the way we measured productivity is, again, back from the industrial age, and it's not really well suited for the technology age. So measuring
Fair enough. Yep.
how we're actually, what productivity is really doing is it's under measuring it.
All right, let's pivot. I cannot believe we're already 30 minutes in. You and I could probably do a 2-hour show if we were given enough of a window. Let's talk about
Pretty
U.S.
good.
housing.
Yeah. So this is something that people aren't really talking about with, which surprises me. We're seeing, yes, home prices have been skyrocketing, but a lot of that has been driven because of such low volumes. Like we have really, really low volume of homes. So people aren't putting their homes on the market, which so small supply, which is just pushing prices up. Great for homeowners to see their home prices go up. But what we have been seeing that is concerning when we look towards the second half of this year is that homeowners pulled almost $50 billion in equity out of their homes in Q1. That's the highest level, to put it in context, since 2007. And that's up nearly 80% year over year. That is a lot of cash, right? That's the home as the ATM again. That's a
Yep.
lot of cash flow that was coming into homeowners' pockets that they could then go use to spend. So you had this big, unusual, right? And that's not something that's like recurring cash flow. That was the problem we learned back in 2006, 7, and going into 8, that crash in consumer spending because people had been using their homes as ATMs. That just happened again. That's a little bit concerning. We had both the home as an ATM and you had those stimulus checks. So big shock that there was a huge spending spree. Not exactly. That is, I think, a big headwind to spending going forward. All this talk about savings and dry powder, not really sure about that. What we're seeing in housing too is some signs that this could be rolling over. That mortgage applications, it's been rolling over. While that had just been going up and up and up, it's starting to slow. And the level's now down to where it was February 21st, the week of February 21st in 2020. That wasn't exactly a great time, right?
Right.
The purchase index fell 3.1% and is now down in 2 of the past 3 months. And it's now off 18% year to date. So again, some signs that this may be slowing, which is, anytime you see such asymptotic moves like in housing prices, in cryptocurrency, there has to be a correction going the other direction. So not a big supply there. So
Yeah, I feel like we've been talking about that for a couple of quarters now, and we're waiting for this movie to play out that we've seen before. But as I've learned, bubbles can blow bigger than you ever thought. I will say anecdotally, in the suburbs of Atlanta, I do see significantly more for sale signs that aren't moving as fast as they used to. 6 months ago, you put your house up and somebody was coming in and buying it sight unseen sometimes. Not as much anymore.
And I think a good bit of that's kind of what we've been seeing with the markets is the stock market, is that there was so much optimism already priced in, so much perfection priced in, that what was going to come in and be a positive surprise to the upside. We saw this with the recent earnings season, where companies could beat on top line, on bottom line, and improve guidance, and their share price went down. That wasn't an unusual thing to see. And when you see that happening pretty frequently, that's just telling you that there was an awful lot priced in. When you look between now and like the end of the year, what kind of spectacular news is going to come in that's going to go, oh, this is fantastic, didn't see that coming, and reason to be excited. And now, but also to your point, that these bubbles can go on longer. This is a market that is very difficult to ever go against, because the federal government, and particularly the Federal Reserve, seem to have really tied their own personal metrics of success informally to the stock market. So if we see the stock market really starting to take a hit, and it's been pretty boring lately, pretty flatlining outside of course, meme stocks. Wendy's is now the new hot thing. I wouldn't be surprised to see the Fed stepping in and maybe providing a little support as it does again, because part of that makes sense in that you've got a ton of baby boomers who desperately need their retirement accounts to not tank because the government couldn't really step in and support them. So you need to keep that stock market up. Now, The attempt versus the ability, that's a different conversation, but
That's a whole
wouldn't be
nother show,
surprised to see-
Lenore.
Exactly.
That's a whole nother show. All right,
So
let's
kind of
put this all together and talk about
Yeah.
your thoughts around GDP as we wrap this up. So,
the bottom,
given
bottom
everything
line
we've
is, we're seeing those expectations are starting to come down, right? The Atlanta Fed nowcast was expecting about 13.6% for Q2. It then dropped to 10.3, and now it's down about 9.4. And it's kind of known to always be a little bit on the high side. Add in that this metric I really follow a lot, the Citigroup Economic Surprise Index, the SESI, that has rolled over. And what that measures is how the economic data points are coming in versus expectation. So if it's moving up, it's meaning things are coming in better than expected. And if it's moving down, things are coming in worse than expected. It's now where the economy was last June when things were in lockdown mode. We were 5 months away from any vaccine announcements, when it was just pretty grim out there. So what we are seeing, the economy still, it's good. I'm not saying that, the sky's not falling. It's just, it's showing, because there's economy and the market are two separate things. The economy is showing signs of this recovery slowing. So that pace is slowing. And meanwhile, the stock market has the expectations for whoa, and it is already priced to perfection, which means that across the board, those major indexes are going to most likely struggle, barring any sort of, happy shock or negative shock. It's going to be struggling, but that doesn't mean that there aren't specific themes that can still do well.
Happy shock. That's a new term. I think we need to start getting that into this recovery here. We like to see lots of happy shocks in the economy. Lenore, let's wrap with this. So next time you and I talk specifically about the economy, and I want you to forecast here a little bit. What do you think the 2 or 3 hot topics we will be talking about? And keep in mind, we now cut clips out, and I'll be playing this back for you.
Yep. I think the lack of labor, I think the labor force participation rate is going to become more of a topic. The kind of the U6, that larger measure of unemployment, is going to get really, really frustrating. And I think that's going to slam up against stimulus talks, because it's really interesting right now to have the Fed and even Janet Yellen on the one side talking about, do we need to consider taking some measures to put some brakes on because of inflationary pressures? And at the same time, you've got the administration saying, I need this multi-trillion stimulus package. That's like drinking coffee and taking a Unisom. So I think that'll be a big topic as well. And I'm hoping that productivity is going to be a big topic. It should be.
Lenore, I appreciate you coming on. I always love rolling through charts with you. We'll see you next quarter to talk a little bit more about the macro economy, and we'll revisit these thoughts here. I appreciate you coming on.
Thanks, Jay.
Are you struggling to hold your team accountable? Do you struggle getting them to see your vision and drive results? The Resilient OKR system for financial advisors could be your solution. OKR is an acronym for Objectives, which are your big inspirational goals, and Key Results, which are how you and your team are held accountable. This is the Silicon Valley method that drives growth at major companies such as Intel, Google, BMW, and Disney. Move your business results away from opinions and measure it with data.
Pick up your complimentary access to the Resilient OKR system for financial advisors by visiting resilientadvisor.com/OKR.